That should be enough to get us going. All right. Again, good afternoon. I'm Stroh. All right. And you all are students. Are all of you engineering students, or do we have some different majors? Sometimes we have a few other folks slide in. All engineering? What kind of engineering? Shout out.
Mechanical.
Mechanical. What else? Agricultural? Cool. There's a ringer there in the back of the room. He's been through this. That's it. Just two.
Civil.
Civil. Okay. Just three. The rest of you don't know.
Biological.
Biological. Do you know how to spell engineering? Kidding. Okay. Just trying to get somebody to participate, that's all. Civil engineers are good. Okay. It was a structural engineer that designed this building so that we had all this light. All that concrete and all that steel. A guy named Mike Natali came and spoke to my class last fall. Yeah, he was very proud of it. I'd like to see it. It's very cool. So, okay. This is part 4, hopefully, of a 4-part series about a little bit about business and starting a business and entrepreneurship. Okay. No matter what kind of business you've got, even if it's a not-for-profit, financials are important. And that's what this is about. Okay? So we're going to try in 50 minutes. Andrew, I'm right, this is 50 minutes till 5:20. Don't want to keep you too late. Okay? We're going to try and give you at least that 25,000 foot view of what financial statements look like and how you can use them and why they're important. Fair enough for objectives? All right. With that, we can skip a couple of these because we've got that. That's who I am. I got a BSIM and an MBA from Brann. I got another MBA. Kind of an overkill, but that's okay. All right. I am obviously a Purdue grad. Boiler up. This is a good place to be. Corporate experience and entrepreneurial experience. I worked for a very large corporation off and on for many years, total of almost 30. That corporation was United Technologies. Lots of engineers in United Technologies. I led an engineering design team one time. I do not have an engineering degree, as you just saw, but it was one of the most fun projects I was ever on. Okay. Been involved in a lot of different business startups, too many to mention, a lot of different restaurants, a retail golf shop, wholesale heating and air conditioning distribution, ambulance business, nursing home business, that kind of stuff. A lot of different things. Okay, so that's my background, or at least a little bit of it. I am a Hoosier by birth and a Boiler by design, as all of us say. I'll share this with you, Andrew, on a flash afterward, and then you can get it to them. Is that an easy way to do this? Yep. All right. So you'll have my email and my LinkedIn connection, if you want it, for later on. All right. The goal for a for-profit business is simply that, to create and increase value in your business. And you do this by outgrowing and out-earning the competition. And as you'll see in a few minutes, outgrow means the top line on an income statement, the revenue. And out-earn is the bottom line, the profit. It doesn't do you any good to increase your revenue 10 and 20-fold if you don't increase the profits equally or close to equally. Okay? That's what we're here to find out how to do. Fair enough? All right. Why care about financials? Well, okay, it's number stuff. Hello, engineers. It is all about numbers. I'm going to move this around. This is always easier. Yay. No, I don't want to do that. That was a no. Thank you. All right, so now we've got this over here in case I need to switch it, which I will. Okay. They're more concrete than marketing, which we like. Marketing is all squishy. It's kind of like Mississippi mud. This is concrete. Okay. This is kind of like what you're used to. It's not Diffie Q, but it's numbers. All right. They're how we measure a business, how well it's doing or not doing. And that's pretty important, even if you're a not-for-profit. And it is all about, and the C and the F from the first slide and now is cash flow. Okay? If you're not making positive cash flow, you're out of luck. You will run out of money and you'll be out of business. So that's why it's kind of important. Okay, there are three financial statements. An income statement, which is sometimes known as a profit and loss, or abbreviated P&L, and then a balance sheet and a cash flow statement. Those are the three main statements. There's some subsets to it, but that's really the concrete part of it. Every business has them, large or small, whatever your kind of business is. Okay? This is, and there's another file which I will have on the flash drive which expands on this, but this will describe for you those three kinds of businesses just in a word description. The income statement. Income statement covers a period of time, a month, 3 months, for a quarter, a year, whatever. It tells you what happened during that period of time. Okay, and we're going to contrast that to a balance sheet in a minute. Okay, it tells you where you got money, how much money you got. It tells you where you spent the money. Okay, all those expenses and costs of doing the business, and it tells you what you got left at the end of all of that. Okay, hopefully it's positive. It isn't always, and for a startup business, it almost never is. For a few months, maybe for a year. Okay, it just happens that way. All right, that's an income statement. Which one's next? A balance sheet. The balance sheet is a snapshot. It's a point in time. It's at the end of the month. It's at the end of the quarter. It's at the end of the year. It's on December 31st, 2017. This is what our balance sheet looked like. And on January 1 at 10 a.m., it might look very different. It probably won't be very different, but it'll be different. Okay, it changes. So in order to compare and understand balance sheets, you need two of them. And we'll see that in a little bit. Okay? A balance sheet is where a person that owns a business ought to manage the business from. Because that's what you care about. What's the goal of a for-profit business? Create and increase value. It's your balance sheet that tells you whether or not you're doing that. Your income statement tells you that you might be because you've got a positive profit, but it really doesn't tell you whether you're creating and increasing value. Okay? So you should manage your business from your balance sheet. And a balance sheet, as we'll see in a minute, and we'll talk about assets and liabilities, and then owner's equity or net worth of the business. All right? That's what's on there. The assets are what you own with an N. The liabilities are what you owe with an E. And the net worth, in essence, is the difference between the two. All right? So we'll see how that balances. And a cash flow statement is sometimes called source use, or where got, where gone. Where do we get money from? Okay, usually it's sales, but we could have borrowed some additional money. That would be a source of cash. All right, or when we sold some assets, we liquidated some stuff. That could be a source of cash. There's some that we don't think about, but primarily let's just think in terms of your revenue. That's a source of cash each month, each year. Okay, and then what did you do with it? We spent it. You know, we paid salaries. We paid suppliers. We bought a new truck. All those kinds of things. Those are the kinds of expenses that flow down. And then at the end, you've got your ending cash balance. You start with the beginning cash balance, add to it all your sources, subtract all your uses, and bam, you've got an ending cash balance, and hopefully that's positive. And then you throw that one up to the top of the next period, month, or whatever, and that becomes your beginning cash balance, and you keep rolling it like that. Okay, questions? Understand? Pretty straightforward. 3, income statement, balance sheet, cash flow. Cash flow also covers a period of time. The income and the cash flow cover a period of time. It's the balance sheet is the only one that is that snapshot, that point in time. Okay? All right. A quick look. All right, this is why I got to shift gears. Let's do that. And show is the easiest way, and now I can get at this, and let me show you that. Big enough. Everybody can see the numbers? Good? I can scale it up if you need it. You already good? Okay. That's a balance sheet. I'm going to start with the income statement. Let me switch over there. These are balance sheets. They're modified. They're kind of condensed, but it was a real company, It was not Dewey, Cheatham and Howe, but it was a real company. It was a startup company that started in 2004. Okay? And this is what their income statement sort of looked like. All right? Up at the top, you've got sales. I shouldn't have done that big. That's terrible. I'll change that later. All right? Yeah, now you can still see it. You've got sales less cost of goods sold. I'll explain that when we go to this in more depth. But basically, it's what did it cost you to get the stuff that you're selling? Okay? If it's a tangible product, there's a lot involved. If it's not, if it's software development or whatever, there's still something involved, usually, but not always. Okay? So you subtract that, you subtract the cost of goods sold, and you end up with gross profit or gross margin. And then you've got that money to spend to cover all these expenses that are here. Management wages. Wages are almost always at the top because they're usually your biggest thing. But you see a whole bunch of stuff there, and businesses will vary. Everybody's going to have salaries and wages, but you might not all have commercial creation. You might not all have credit card expense, okay, that kind of stuff. All right. Credit card expense is not your cost of using your credit card. It's the cost of you paying MasterCard when somebody else uses it with your business. Okay. If we had time, I would go through and I'd show you how you could tell from that income statement what kind of business this is. Once you do a few of these, it's pretty easy. So the next chunk on an income statement after the expenses is a bunch of stuff on taxes if you've got them, less interest expense, because interest expense is deductible. It reduces your income, so you pay less tax, so we treat it a little differently. All right, but then you got a bottom line, and it says, let me see if I can change this on the fly real fast for you. Draw, and we'll do that. And that, okay. Net profit and loss, okay? And it is in brackets, it's in parentheses, and just like anything else in math, that means it's negative. We lost money, okay? C'est la vie, all right? But remember that number, that 20,622, fair enough? Here's what a balance sheet looks like for this company when they were starting up, all right? Same 3 years, balance sheet. You've got assets, and by convention, we start with current assets, and then we go to non-current. It used to be called fixed, but this is broader. The definition of current versus non-current is 12 months. If you can turn it into cash in less than 12 months, it's current. If it's going to take you longer, like a building might take you longer, or, well, that's enough of an example. But obviously cash is cash, but accounts receivable, you can sell those. Okay, if people owe you money and it's good debt, you can sell those. You won't get 100% for them, so you can convert them into cash. So they become current assets. Non-current are tangible stuff. These chairs, desks, that computer thing would be a non-current asset. The building itself is a non-current asset. Okay, so again, as I said, those total up to 88,152, and that's what you own. Okay, you got that. You bought that. You paid for it. Your company owns that. And if you're the sole owner of the company, then you own that. And then the flip side is current liabilities and non-current, the liability side. We owe some money. We got a notes payable there, and we owe a bank or whomever we borrowed from. And there's probably a portion on that that says long-term balance, so that might be one note, and part of it's due within 12 months, and the rest of it's due in 2 years and 3 years and 4 years, and that's the long-term part of it. Okay? So as you'll notice, if we look at the 88,152 and the 83,730, it doesn't balance. You go, oh my God, it's a balance sheet. Stroh, what's going on? Well, we got this equity portion, this owner's equity, okay, the net worth of the company. The owners injected $25,000 to get this started. They also borrowed some money, but we'll see that later. And there's that crazy number that I ask you to remember, the 20,622, and that's called retained earnings. Think of that as your savings account. Where did it come from? So when everybody talks at once, it's so loud I can't really. Where did it come from? Where did you just see it? Play along with me. It makes me feel better. I drove all the way up from Carmel just to do this for you. Play along with me. Pardon? Yeah, but it was a loss, right? So it's negative, but it comes from the bottom of the income statement. If you have a profit, then it's positive. If you have a loss, then it's negative. And that's where you park it temporarily, retained earnings. That's to create an increased value. You want that number to start growing. This number right here. Doom, 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 right there. All right? You want that to keep on growing. All right? And then you plow it back into the company. And you do other stuff. Think Amazon. They got more money than the Federal Reserve. Okay? For years, they would not show a profit. I don't know whether they do now or not. It doesn't matter. I guarantee you they're profitable. You know they're profitable. They're not doing all that stuff and not be profitable. They're just plowing it back into the business because Jeff Bezos is pretty darn good at what he does. Okay? So don't worry about a loss if it's a short-term loss. Balance sheet. Fair enough? That's the balance. I guess I should tell you. Assets, it used to be like this. Assets equal liabilities plus owner's equity. So that's the balance. And that's why the 88,152 that I circled before in this one, that's the balance of a balance sheet. Snapshot point in time. Fair enough? We good? Moving on to cash flow. All right. This is what their cash flow looked like. Beginning cash on hand was zip at the beginning because they were just starting. They sold nearly $400,000 worth. They borrowed $100,000, as I told you. Okay, and the owners injected $25,000 in. So they had, over the period of the first year, a little over $500,000 to play with. $521,000. What did they do with it? That's what this shows you. All of that. They spent it, crazy people that they are. They increased their inventory. They paid wages, as you saw on the income statement. A lot of this stuff comes from the income statement, but some of it comes from changes in an item on the balance sheet. And that's really tricky, and I can't do that in 50 minutes, but trust me, they do. Okay, if your inventory goes up, that costs you money. That's a use of cash. Okay, at the beginning of this month I had $10,000 in inventory. At the end of this month I've got $30,000. How in the heck did I get $20,000 more? I bought it. Okay, I used cash to buy that. So that can be a use of cash on a cash flow statement. It's not all just straight expenses I paid wages. All right? So once we got that totaled up, the cash outflow is this 493 number. And the difference becomes your cash available. And that then becomes, oops, we don't have the top there. There you go. Your beginning cash balance for the next period, the 27,000. Goes up to the top, and then you go through the same drill. Okay? Income statement, balance sheet, cash flow. All of them important. I'm spitting cotton up here. Let me get some water. All of them are important. But remember, you manage your business from your balance sheet. That's where you see how much you're growing the business and how well you're doing.
So if you're, say like a grocery store, inventory purchases, obviously the food you sell. If you're in manufacturing, is that cost of raw materials?
It depends. Yes, some of it is. Some of it for sure is. Okay, it is definitely cost of raw materials. Inventory could be supplies that you inventory. Okay, even packaging, but think supplies in the office because it's got an office. So there can be different kinds. And you would put those down in the expense side of things. But the raw materials are part of cost of goods sold. Usually a fairly significant part of cost of goods sold. Okay. Sir?
So you said at the beginning...
Uh-oh, you remember what now? See, now I'm going to have to remember what I said too. Go ahead.
It's all about cash flow.
Uh-huh,
But
it
you
is.
just said manage the business from the balance sheet.
Mm-hmm.
Can you explain kind of why you said both?
Yeah, I'm not sure why you think of that as a contradiction, so let me elaborate. You manage the business from the balance sheet, okay, but how you create increased value is by bringing in more money than you spend. That's cash flow, okay? If my revenue goes up by $300,000, but my expenses go up by $500,000, I'm going backwards. Wrong cash flow. It is cash flow, but it's cash flow out. Okay? That's what we mean by cash flow. If you do it the right way, in that bottom line, that profit, that net profit, is a positive number, no brackets on it, then that goes over to retained earnings, and it grows. And retained earnings, your savings account, as I call it, nobody else does, increases, and that's the increase of the bottom line. Okay? Outgrow and out-earn the bottom line. Bottom line expands your retained earnings, take your retained earnings and spend them. Okay, now you can spend them on a, let's go to Tahiti, but better spend them by plowing it back into the business. Does that explain it? Yeah. Okay, if it doesn't fully, give me a few more minutes and then we'll circle back, all right, and holler again, okay, and I'll make up another answer. 87% of all statistics are made up on the spot. They really are. 90%? Oh, it's gone up. Okay. Wow. All right. So, with that in mind, I won't pull that back up. A closer look. Breaking the statements down into their major parts, let's take a look at one. All right? And oddly enough, I just happen to have an example. Okay? A little bit of this is repetitive, but we're going to dive a little bit deeper as much as we can within the time frame that we've got. The three statements are, and you know what they are. Okay? So we got that part. Profit and loss. It answers the question, is this company making money? I thought this was a touch screen. Is it not? Oh, it's not because I'm on that. All right? It's a good thing I brought this over here. I'll do this. All right? If the answer is no, then it's operating at a loss. Fair enough? There's a quick way to tell. You look at the bottom of the statement, we've already covered that. Okay? A positive number looks like a positive number that you're used to. If it's got a negative sign, or if it's in brackets, or in red, whether it's in red or not, if it's in brackets, it's a negative number. Same thing that you're used to. All math works the same way. First example means, and you can read through that. All right? The third one just shows the second way of doing it. If you look at the profit and loss statement of the boiler up products, we can learn a few things, okay? So let's do that. The image on the ya pues wants to jump around a little bit on me. Well, we'll start right here. Yeah, I thought I would get the whole thing on there. Don't worry so much about all this detail and percentage because we'll get to that, all right? The first section is the income. This company made and sold 2 products. 2 different kinds of exercise stuff. It's a technical term, stuff. Okay? And they manufactured it themselves, so they've got cost of goods sold. Cost of goods sold is the labor and the material, and there's some indirect cost of goods sold also. Okay? The raw material that Andrew asked about earlier, that's cost of goods sold. The labor, the people that are putting it together, not the people in the office, people that are putting it together, that labor is cost of goods sold. It's things that you can associate and identify with each unit that you sell. Okay, we brought in $100,000 worth of raw material and we made 1,000 things. So the raw material cost for each one is 1,000 into 100,000, boom, and you got it figured out. Okay? That's cost of goods sold. When you subtract that from your income, then you get gross margin or gross profit. All right? Now would be a good time to talk about these percentages. This shows you that the gross margin is 49.66% of that number. That's all that is simple division, those two. All right? Another way to say that helps those that aren't familiar with financial statements is that for every dollar of revenue, we've got 49.6 cents of gross margin to cover all of our expenses and hopefully have a profit. For every dollar of revenue, in this case, we've got a little over 49 cents to spend or keep as a profit. Okay? You're leaning around this, young lady. You should have said something. This thing moves, and there's a reason why it does. How's that? Okay? All right. Gross margin represents blah, blah. Okay. Salaries, wages, business expense, and interest expense. you usually break out, I didn't on those others, but you usually break out salaries and wages because it's important. It is all about cash flow, but it's the people that get you the cash flow. They are your most important part of your business. And that's why you spend the most money on them. So that's why it's usually separated. You don't have to, but most people do. Okay? And this tells you that your $185,000 worth of salary and wages was 16.5% of your revenue. All these percentages are percent of revenue. So for every dollar of revenue we brought in, we spent 16.5 cents on salary and wages. Okay? And on down the line. All right. Business expense is pretty much the total of just about everything else except that crazy interest thing. Okay? And if you've got interest, it's a good thing. Sort of. Okay? Because you can subtract interest from your income before you pay taxes. You reduce the income, you pay taxes on less income, you pay less taxes. That's part of the benefit of being in a business and using interest as leverage. And that's about as far as I can go on that one in 50 minutes too. Yes, ma'am.
One of the things I've noticed looking at this balance sheet, I feel like a lot of this information is like a summary of other sheets, like the payroll page. Like you obviously have a lot more than just one employee, so there has to be like a document somewhere. I imagine there is with the exact breakdown, right?
Oh, absolutely. A veritable plethora of them. As I alluded to at the beginning, there's 3 basic financial statements, and these are them. There are a lot of things that support them. Okay, there are journal entries, and that's what accountants do. Hire a good accountant. 2 things, ladies and gentlemen. When you start your business, and I hope you do, hire a good lawyer and hire a good accountant. Even if you got an accounting degree, do not be your own accountant. You don't have time for that. Okay, but that's what they do. The detail is for them. What you need to know is what the financial statements look like and what they're telling you. And there's books and books. Look at the financial statements for a large corporation, and you'll look at the numbers. I will tell you right now, if you want to analyze a publicly traded company with all those pages and pages, don't look at the numbers. Look at the notes. Okay, the numbers lie, the notes don't. Okay? All right. How much was total income? Well, we know that. Okay, that one's pretty straightforward. It's just the total of the 2 things, and it's $1.1 million. What is the gross margin percentage? I just gave it to you a minute ago. For those of you that were paying attention, following along. Gross margin percentage is? Yes, 49.66%. Okay? That was that number we just talked about. Now, if the gross margin, this is going to be a tough putt. You ready? If the gross margin, that 49%, was 25% instead, about half, would the company have made money or lost money? And the answer can be found in that part. If, as we said, how am I doing? If, as we said before, that we have 49 cents out of every revenue dollar at the gross margin line, if you look at the bottom line, the net operating profit, you see 18.4%. Does that tell you that we have 18.4 cents out of every revenue dollar left at the end of the day when the sun sets? Yes, it should. Okay? And it's positive. We actually made money, $200,000 worth. So we made 18 cents on every dollar. Okay? Now, just picture this. You don't have to have any accounting degrees or anything else. This is pure math. This is what you people do for a living. Okay? If instead of having 49 cents to cover all of our expenses and hopefully have a profit, we only had 25 cents, would we be profitable? I want an answer. I get a no. How many say no? How many honestly say no? How many aren't sure yet? It's okay to be not sure. Okay? If at 49 cents on the dollar of gross margin, we make 18 cents still. If we reduce the 49 to 25, we're basically